Okay, so today we're going to discuss the topics we haven't finished, we haven't discussed. So first, we're going to finish the capital budgeting topic. This is the last worksheet in the capital budgeting Excel spreadsheet. We haven't completed the investment opportunity schedule. And then we will go to the bond and stock valuation. I posted a file in our Canvas, bond and stock valuation, May 29. So that's the next topic that we're going to finish. And then we go to a weighted average cost of capital, which is this one. And then lastly, the risk and return. So we have a lot of topics to cover. Hopefully we'll be able to finish it in hopefully in 1.5 hours time, or at maximum I think siguro mga 2 hours, no? This is recorded, so you can go back to this one and view it. Okay, so let's go here. Investment opportunity schedule. Suppose we have several projects, and these projects are, let's assume they are mutually exclusive. When we say mutually exclusive, we mean that the projects can be chosen based on their IRRs. Okay, if the weighted average cost of capital of the company, for example, is 12%, we know that there are projects here that will not make it. For example, 11.48% will not make it because its IRR is only 11.48%. But the rest are acceptable. And since it's the projects are mutually exclusive, it means that the projects that have an IRR of greater than 12% may be accepted. The only constraint there is if it already exceeds their budget. So this investment opportunity schedule addresses that. Now I already gave you the solution here, but let me just tell you how to do this, because you won't be able to do it just by looking at the instructions. So first we sort the IRR from highest to lowest, okay, because the end goal is for us to be able to come up with this step ladder function of your investment opportunity schedule. And then we will cumulate the cost and then insert a row per project. Okay, I'll explain this. Do the same for all projects, and then finally plot using scatter plot. Okay, so this is the end goal in mind. Okay, so we will have to do this first. Okay, so let's first sort. Let's go back to our data. So we will have to sort by IRR. So data, sort. We sort according to IRR values. We sort from largest to smallest. Okay, so we have now sorted our project based on IRR, and of course when we choose projects, we would choose first the ones with the higher IRRs. Okay, so if we're going to rank this, project B has the least preference. Okay, project H has the biggest preference. Okay, and then the next step is to cumulate the cost. Okay, cumulate the cost. How do we cumulate the cost? So we have here, let's insert here another column, cumulative. Okay. So if you recall last time, I taught you how to cumulate. So we just get the sum of the first cost and then colon, and then it will give us the same cell address. And then we'll just fix this one, F4. We just need to fix the row. So that's $5, because we're going to copy the formula going down, which means that the column position is not changing. So no need to fix the column. Okay, so Control Enter. And then if I drag this, you notice that it will add this one and this one to get 803. And then copy down. Okay, so this is now your cumulative cost. Okay, so we will just be needing the cumulative cost and the IRR. Okay, we will have no more need for this. So what we're going to do is we're going to remove the formula. So let's remove the formula here. So Control C and then paste the values. So these are now only values. And then we will, let's just, okay. So we actually, what we're going to do is we're going to plot. So for example, for project H, we're going to plot, it's from 0 up to 407. So in order to do that, because we need to plot this line, so this line is from 0 up to 407, we will have to insert this point 0. We already have 407,000. We need to insert 0 so that we can plot this range from 0 up to 407. So how do we do that? Okay, let's insert this. Let's insert a line here. Okay, and then that's we have to do the same for the rest. So let's keep on inserting per project. Insert. Insert. until you have inserted rows between the projects, all the projects. All right. Okay, so what we need to do is to, so we need to plot that portion from 0 up to 407,769. So we need to put 0 here, 0 here, 0 to 407,769, the IRR will be equal to 16.51%. So if you take a look at this, guys, this is from 0 up to 407,769. The IRR is 16.51. Okay, so that's how we plot that. Now, for the next one, starting with, okay, so you notice this one starting from 407,769 until 803,978. Okay, but how do we ensure that there will be a drop here? So the technique is to, okay, the technique is, okay, let me highlight this because we're going to do the same for the other cells. In order to assure us, to make sure that, ensure that we'll have the drop down, we will be equating this one. Okay, so it starts from 407,769, and then we're going to add a very small incremental number, 0.01. Okay, by doing this, we are ensuring that there will be a drop down, a drop in the plot. Okay, if you take a look at this here, so that will ensure that there will be a drop in the plot. Okay, so let me flash that again, 0.01. And then the IRR will now be equal to 1661. So what happened is that from 407,769.01 up to 803,978, the IRR is 16.16. And that accounts for this one, for this line. Okay, that accounts for this line. All right, so now for the next one, it's the same. We add 0.01 here, and then we copy this IRR. Okay, because IRR will now be from 803,970 to 8.01, the amount, I mean, the cumulative cost, and then the IRR should be 15.87. So we can now just highlight this and then copy, Control C, Control V, Control V, Control V, Control V, Control V, Control V, letter V, Control V, Control V. That's just copy paste. Okay. So now we have set up our stepladder function. Okay, so this is your cumulative cost. So we can now plot this, highlight everything here, and then insert, scatter plot, and then we can use this one. We can use, or this the one with the line. Okay, so this is now our investment opportunity schedule. We can do some formatting here. Okay, so you notice that the plot is quite high. So we can just format the axis, for example. Let's right click this, format axis. Let's make the minimum as 0.11, because I think it's the minimum is 11.48. So I made this 0.11, enter, enter. Okay, so it looks like now more a stepladder function. Okay, then maybe we can choose the design of this. Okay, we can choose from this one. Okay, let me just choose this. Okay, so this is our investment opportunity schedule. What does this mean? What does this mean? The implication for this one is that this is project H, okay? This is project H, and the budget of project H, the cost of project H is 407,769. Okay, so that means that if we only have 500,000 budget for initial investment, only project H will be acceptable. Because if you're going to do project G, H and G also, we will need to have already 803,978. If we have 1 million, then we can include project H and G. We cannot include I because you will need up to 1.243 million in order to also include I. Okay, our preference is of course project H first, and then G, and then I, etc. And that can be shown here in this investment opportunity schedule. Okay, so as we said, guys, we can actually here, what I did here was to plot a line, a vertical line, for example, at 1 million or at 1,500,000. Okay, if our budget is only 1 million, then what we can do is only project H and project G. We cannot do project I because it will up to project I, that's 1.2 million. It will exceed our budget. But if we have 1.5 million, for example, as our budget, then we can include project I also. Okay, but not project F, because project F is up to 1.514 million. Okay, so that's what this does. Now you can easily, for example, how do I now plot this? That's very easy. So I have to identify the points of your x-axis and y-axis. For example, for this one, okay, so let me do it here. Let me copy this. So if I want to insert the plot for 1 million, this vertical line here, okay, I have to identify first my x-axis, my x and y coordinates. X is 1 million, okay, and y is 0 at this point, and x is 1 million and 17% for y. So I plotted that here. X is 1 million, y is 0, and x is 1 million, and then y is 17%. So I can now insert that here. What I have to do is just click here and then select data. Okay, and then we're going to add, let's call it 1M, let's call it 1M budget. So the X values are these two, 1 million, and the Y axis are this, 0 and 17%. Okay, if I click OK, there goes your vertical line. Okay, so the Y axis increase. So let me just format that, format axis, and then I'll make it maximum 17%. Enter. There. So here we can see the vertical line. If the budget is 1 million, we can only include project H, and project G. If, for example, we want to insert this 1,500,000, the same thing, right click on your plot, select data, okay, then add. So let's say we call it 1.5 M budget. Your x-axis is this two, 1.5 million. And then your y, we have to delete this and highlight the 0 and 17%. Then okay. Then we now have this. Okay. Then again, if I want, for example, to plot a horizontal line, let's suppose that the required weighted average cost of capital is 12%, then I can just add these points. So for x-axis, that's 0 up to, let's say, 3 million. Okay, so 0, 3 million for x-axis. And then for y, it's both 12%, 12%. So this is the first point, 0 and 12%, that's this one. And then the next point is 3 million and 12%, so that's this one. And then we're going to connect it by a line. So once again, insert, select data, add, let's say we call it WACC. This is our WACC. Our x-axis is, oops. Our x-axis is these two. And our y-axis will be this one. Okay, and you can just can format this. Maybe the weight. Let's increase the weight a bit. There. You can also change the color if you want. Okay. So what can we learn from this investment opportunity schedule? Here we know that all the projects that have IRRs above 12% are the ones that are acceptable. So that constitutes project H, G, okay, until project E. Okay, because project E has an IRR of, project C, 12.19. Okay, so that's this one. This is project E. Project E and B have IRRs that are lower than 12%, so they are rejected. So that's assuming that your weighted average cost of capital is 12%. Of course, you can plot another one here depending on what you want. Okay, so this is that's how we do the investment opportunity schedule. Okay, so any questions? Okay, if none, guys, we'll go to the next one. So let's kindly open the Excel sheet on bond and stock valuation. May 29. Okay. So in this lesson, we will be learning how to value an asset. Any asset for that matter, we know we have learned before that in order to value any asset, we just need to determine the future cash flows that can be generated from the asset and then get the present value. So by getting the present value, you know the current intrinsic value of that asset. Okay, so here, this is an investment in bonds. Okay, we know that a bond is a type of investment where the issuer, the one who borrowed money, will pay the investor interest and at the end of the term, principal. The principal amount or the face value of the bond. Okay, so in this worksheet, bond and stock valuation, May 29, we're going to look at valuation for bonds and stocks. So let's start first with bonds. Okay, when we talk of bonds, there are a bond would have what we call the face amount. So this is technically what's being borrowed by the company or by the one issuing the bond. Let's say the face amount is 1,000, and then you have to have also the maturity or the number of the term, okay, which is the number of years, the bond, in how many years the bond will be paid, okay. But before before the at the end of the term, the face value will be paid. In this case, 1,000. However, before the end of the term, there is this promise to pay interest rates. And the interest is defined by the coupon rate, okay? So in this case, the company is borrowed 1,000, or the company, let's say from our perspective, we invested, okay? There's this promise to pay 1,000. The coupon rate is 8%, which means that we will be paid 8% for each year for 12 years. Okay, but there's this other information about the required return, or this is the existing or prevailing market rate. Okay, which means that any a bond of the same nature in the market today pays at 12%. So, but the bond that you're going to invest in will only pay 8%. Okay, so what's this? What does this mean? Okay, so let's take a look. In order to appreciate that better, let's compute for the value of this bond. So the best way to understand this is to plot the cash flow. Okay, so what will be our cash flow as an investor? What will be the cash flow? Okay, so the cash flow will be, we're going to receive 8% of the face value. So that will be is equal to 1,000 times 8%. Okay, so we fix this because that will be the same value we're going to have, okay, for the next 12 years. Okay, so 80 pesos. Okay, so let me just remove the decimal here. 80 pesos for the interest for 12 years. But at the end, we're going to have the 1,000. Okay, the return of the principal. So this is the cash flow. From year 1 up to year 11, that's 80. And then on year 12, it's supposed to be 1,080. So it's the interest plus the principal. So this is the cash flow for this bond investment. The question is, what's the value of this bond? Okay, so the value of this bond will be computed using by getting the present value of this. So the question is, how much is the equivalent present value of this stream of cash flows now? That will be the price of the bond. Okay, that's how much the bond is worth. Okay, all right. So how do we compute for this? Well, we use the present value function. Okay, I don't think I was able to erase this. No? So let's just erase this first. Okay, and let's do it. So we can use Excel's PV function. I'm going to put here negative PV. Okay. Now, what's the prevailing market rate? Okay. Take note, the rate is different from the coupon. The rate here is the prevailing market rate. So it's telling us that a bond of this nature, the current market rate is 12%. So you notice immediately that there's a discrepancy because the company was promising to pay at 8%, but the prevailing market rate is at 12%. Okay, so the rate is 12%, then comma, and per, assuming this is annual, okay, this is annual payment, okay, so the number of years is 12, comma, okay, what are the cash flows? So you have two cash flows, the payment and the future value. So this is the payment, this is the annuity, 80, and then this is the future value. So you notice you have two types of cash flows here. One is the annuity of 80, and the other one is the 1,000. Okay, because whether you're the investor or the issuer of the bond, so let's suppose we're the investor, we're going to receive 80 for the next 12 years plus the 1,000 at the end of the 12 years. Okay, so this is the cash flow that we're going to have. Or if you're the issuer of the bond, this is the amount that you're going to pay every year, and then at the end of the period, you're going to pay 1,000. All right. So PMT of that's C3 here is wait, what's our payment? Our payment is 1,000 multiplied by 8%. Okay, comma. What's our future value? The 1,000. Okay, so control enter. Okay, so the price of this bond is 752.23. What does that mean? Okay, if we're the investor, guys, the amount that we're going to pay, that we should be willing to pay for this bond is only 752.23. Okay, in spite of the fact that the company promises to pay us the face value of 1,000 at the end of 12 years. Okay, so if we're going to buy this bond, if the coupon rate is 8% and the prevailing market rate now is 12%, okay, we should only be willing to pay a lower amount. Why? Because we're being sold a bond that only pays 8%, when the prevailing rate now is 12%. So it means that this type of bond is called a discount bond. So the seller of the bond should be willing to sell the bond at a lower price because he's only going to pay 8% when in fact the prevailing market rate is 12%. Okay, so we can see here that when the required return, when the prevailing market rate is greater than the coupon rate, then the bond will sell at a discount. Okay, and it's even lower if it's semi-annual. So let's compute for that. If it's semi-annual, okay, it means that this is what will happen for semi-annual. This will be the cash flow for semi-annual, this one. So let's plot first the timeline for the cash flow. Okay, how much will be the payment? If it's semi-annual, it will only be 1,000 times 8%, okay? And then that should be divided by 2 because you're going to receive interest twice a year. Okay, so let's fix this. So it should only be 40. 40, copy this. However, the number of periods will be 24. Okay, so take note of this. The difference between this cash flow and this and the other one, the annual, is that this is for 12 periods, while this is for 24 periods because it's semi-annual. And at the end, we still get the face value amount of 1,000. Okay, so this is this is annual, and this is semi-annual. Okay, so let's compute for the semi-annual. Let's compute for the for the amount. Okay. So the rate is 12%, but since it's semi-annual, we should be dividing by 2. Okay, the number of periods is 12, but since it's semi-annual, we have to multiply this by 2. Okay, the payment is 1,000 times 8%, then we should divide it by 2. Okay, and then comma, the future value, the face amount is 1,000. Okay, that's how we compute for this. Okay, so in your finals, you'll be asked to compute for the price of a bond. So it could be a discount bond. So you can easily use Excel for that. Okay, so you notice that if it's semi-annual, it's even cheaper. Okay, it's even cheaper. So what does 752 mean? It means that if you're the investor and you're being offered this bond, okay, 12 years, 1,000 face value, coupon rate is 8%. And if you know that the prevailing market rate is 12%, then you should not be willing to pay for this at 1,000. Okay? Because the promised return, which is the coupon rate, is lower than the prevailing market rate. Okay? Malulugi ka, no? Kung bibili mo to at 1,000, which is the face amount. No? Dapat, you should only be willing to pay for this at a price lower than the 1,000. Okay, and that's why it's called a discount bond. Okay, on the other hand, yung second example natin, may coupon rate daw na 9,000, 80 years yung term, pero ang ano ngayon, ang prevailing market rate is 8%. So itong bond naman ito, nagpa-promise na magbabayad ng 9%, pero ang market rates ngayon, it's only 8%. So, maganda ba yung, technically, maganda ba yung bond na yan? Yes, well, in a sense, yes. Kasi mas malaki yung coupon, mas malaki yung promised return niya in terms of the coupon rate compared to the prevailing market rate. And as you guess, guys, this is what we call a premium bond. So, similar yung computation dun sa taas. So, I'll erase this. So, this is negative PV. Ang prevailing market rate natin is 8%, comma. How many years to? 8 years, comma. How much is the annuity, the promised payment, the interest payment? So that's 9% multiplied by your face value, comma. What's your face value? Also 1,000. At the end of the 8-year period, 1,000 yan. Control Enter. Okay. So this is the amount that the issuer will be requiring from you. No? 1,057. Mas mataas siya kaysa dun sa ibabayad sa iyo at the end of the 8 years. 1,057. Okay? So kung semi-annual siya, okay, negative PV, okay, rate natin is 8%. Sandali ah. Okay, so our rate is 8%, okay? But we have to divide this by 2 because this is semi-annual, comma. NPER is 8 years, but we have to multiply this by 2 kasi magiging 16 periods yan. PMT is 1,000 times 9%, then we have to divide it by 2. Okay, and then the future value is 1,000. The type we ignore because this is usually annuity due. Control Enter there. Okay, so this is the amount that we need to pay, okay, for this type of investment, for this type of bond. And this is called a premium bond because the prevailing market rate is less than the coupon rate. So always look at the prevailing market rate and then compare it with the coupon. If the prevailing market rate is less than the coupon, okay, prevailing market rate less than the coupon, then that's what we call a premium bond. Prevailing market rate greater than the coupon, that's your discount bond. And lastly, we have this, okay? Notice that your prevailing market rate is equal to your coupon rate. So let's compute for that. This is equal to negative PV, okay? The rate is 7% for annual, comma, N per is 10 years, comma, PMT is 1,000 multiplied by 7%, and then future value is 1,000. Control Enter. So the amount that you're going to pay for this, okay, the price of the bond is also 1,000. So it's the same as the face value. Same as the face value because your required return is equal to your coupon rate. So even if this is semi-annual, so negative PV, the rate is 7% divided by 2, comma, N per is 10 years times 2, and then comma, PMT is 1,000 times 7%. Then we have to divide it by 2 because it's semi-annual. Future value is 1,000. Okay, so it's also 1,000, and that's called your par bond. Okay, so you have discount, premium, and par. Okay, so that's as far as bonds is concerned. Bonds, what's important here is that you understand the cash flow. If you understand the cash flow, if you're able to plot for the cash flow, then no problem computing for the price, for the present value. Okay, so the valuing bond is actually easier than valuing a stock, because for bonds, you know the fixed amount that you'll be getting. Okay, for stocks, it's quite different. So let's now go to stocks. Okay, so this is for stocks. For stocks, unlike bonds, you don't have a fixed amount that you're going to get. Okay, so in the 1960s, this American economist by the name of Gordon, okay, what's the first name of Gordon? I forgot the first name. Okay, anyway, Gordon came up with this Gordon dividend growth model. Okay, so this is how stocks are valued. A while ago, we learned how to value bonds. Okay, and bonds are easily valued because we know it's a contract, and we know the face value and the coupon rate, and we would also know the prevailing market rate. So it's very easy to compute for the price of a bond. It could be a discount bond where your prevailing market rate is less than your coupon rate, or it could be a premium bond where your prevailing market rate is greater than your coupon rate, or it can be a par bond where the prevailing market rate is equal to the coupon rate. Okay. On the other hand, for stocks, it's quite different. It's quite different. So Gordon came up with this, which we call the Gordon model. Okay. So let's answer the first question. What is the basic stock value based on a stream of future dividends? Well, same thing, guys. The price of a stock will be determined by getting the present value of the expected future cash flow. Okay, for stocks, the expected cash flow are dividends. For bonds, it's actually your interest payment plus the principal. Okay, so the general formula is that if we know the price today, that's P sub O. Okay, the price today is equal to the dividend at after the first year, dividend after the second year, third year, up to dividend up to actually it's infinity, assuming that the company is a going concern. Okay. So what we do here is just we just discount the dividends. So we know this formula, guys. D1 over 1 plus K sub S to the first power. K sub S is the required return for your stock. So this is just the discounted value of D1. This is actually the present value. we just add all the present values to get the price of the bond. Okay, so that's how we value bonds. That's how we compute for the price. Sorry, the price of the stock. I mean, sorry, I stand corrected. The price of the stock. So unlike the bonds where you have a well-defined stream of cash flows, here the dividends can be different over time. So we can the dividends are estimated, and if there is the estimated, if we know the required return, then we can compute for the present value. And if we add all of them, we can get the price of the stock. Okay. Now Gordon came up with this model. He said that, for example, if we know the growth rate of the stock. So if you take a look at this formula, this is the dividend at time zero, dividend now. If we know how much will be the growth rate, assuming the growth rate is constant. So let's say the stock will grow by 3%, 3%, 3%, 3%, 3%, 3%. Okay. Then the price of the stock will be determined by this one. The dividend at year 1 divided by K sub S minus G. So let me quickly illustrate that. So assume, guys, that, so let's plot, for example, we have our dividend here. So that's DO, D1, D2, D3, D4, etc. Suppose the company estimates, suppose the dividend now is, let's say, 2.5, okay? 2 pesos 50 centavos. Okay. And then the company expects that this will grow. Let's say the company expects that this will grow 5% forever. Okay. So this is what we call a constant growth rate. Constant growth rate. So this is our dividends. This is our dividend now. So we can compute for the dividend after year 1, which is just equal to the current dividend 2.5 multiplied by, if it's going to grow by 5%, okay, and then we fix this. Okay, let's increase the font. Let's increase the decimal place. And then I can drag this. Okay. I can drag this continuously. Okay. So what we're saying here is that if the dividend now this year is 2.5, and we'd like to know the price of this stock. Okay, so the goal here is to determine how much is the value of this stock. If the dividend now is 2.5, and then it's expected that this dividend will grow 5%, 5% for the next X number of years, how much is the value of this stock? Okay, so this is your growth rate. And then let's suppose that the required return for the stock, let's just suppose that the required return is 8%. Okay, then we can easily compute for the price of this stock. The price of this stock, okay, let me put it here. The price of this stock, according to Gordon, okay, according to Gordon, the constant growth rate model, okay, is this one, D1 over K sub S minus G. So he's saying that if we know the growth rate, okay, and it's assumed to be constant, okay, constant, ibig sabihin, guys, tuloy-tuloy yan, okay, gusto nyo hanggang 100 years, etc. He's saying that these dividends, all of these dividends up to infinity can be replaced by one value. Okay, in math, it can be shown that this future cash flows, take note, we're not including 2.5 because it's already historical. Okay, tapos na tong tapos na tong 2.5 na to, nabigay na yan dividends na yan, Ito yung mga future, yung 2.63, 2.76. Ang tanong, magkano ngayon yan? So sabi ni Gordon, that can be estimated by, it can be estimated by, okay. So the price of this stock is equal to, sabi niya D1, okay. Sabi niya dito sa formula na to, ito, D1 over K sub S minus G. So it's equal to D1. This is D1 over K sub S. This is your K sub S minus G. Okay. Yan ang value ng stock na yan. No? So intindihin lang natin guys ha. May dividend tayo ngayon. 2.5. So natanggap na yan. Now, expected, ang estimate ng company, dividends will grow by 2.5 by 5% every year continuously. So based on that information, mako-compute natin, may estimate natin yung price ng stock na to. Okay, and how did we do it? Ang price ng stock, sabi natin, this is equal to D1 divided by KS, K sub S minus G. Yan ang price ng stock na yan. So anong assumptions dito? Alam natin yung growth rate, alam natin na constant yan over time. So if that's the scenario, then we can compute for the price of the stock, which is this one. Okay, 87.5, which is equal to the D1, which is 2.63, divided by K sub S minus G. Take note guys, if K sub S is less than G, hindi pa pwedeng model na to. No? Kasi you'll come up with an impossible situation where the price of the stock is negative. So, ninote ko na dito yan, okay? If it so happens that your K sub S is less than G, then we cannot make use of that model. Hindi pa pwede yung model na yan. Okay. Okay, then, dito naman, okay, ito yung constant growth rate natin, ano? Pag walang growth rate, minus G lang, no? Tatanggalin natin G. So it will become D sub 1 over K sub S. So ito yung constant growth rate. Constant growth rate. Ito yung no growth rate. So paano yung no growth rate? D1 over K sub S. Okay, so it's equal to, D1 natin is 2.63 divided by K sub S, which is 8%, 32.8. So ibig sabihin nito guys, ibig sabihin ng D1 over K sub S, yung 2.63 natin, pareho lang yan, 2.63 for the next years, no? 2.63, 2.63, 2.63. So it will turn out that mas mura yung price ng, yung value ng stock na yan. Kasi walang growth rate eh, no? Ito may growth rate siya, increasing by 5% over time. Okay, ito naman, walang growth rate. So, of course, alam natin guys na mas magiging mura yung value ng stock na to na walang growth rate. Okay, so I hope that's clear, no? I hope that's clear. Okay. So ito naman ang sinasabi dito, ito kasi yung stock, no? Dividend na ginagamit natin. Ito naman, pwede rin, actually nag-example na tayo ito dati, where we were able to determine the value of the company using free cash flow. So if you're valuing a stock, ang usually ginagamit yung dividend, pero pag gusto natin i-value yung company, ang ginagamit natin yung free cash flow. We can use that as one of the ways in order to value a company. And we had an example of this before, no, nung first few weeks natin. Okay, so let's go to the last example here. Okay, another stock valuation problem. Now, ang dividend daw ngayon, 1.6. Ang required return ng stock is 10%. Okay, so ito, you have several growth rates. Ang first growth rate, sabi, yung short term, for the next 2 years lang. So for the next 2 years, 10% yung magiging growth ng dividends. And then for the next 5 years, 5%. For the next 3 years, 6%. For the next 4 years, 4%. And then ito na yung long run growth. Ito na yung continuous, no? 5%. So we need to plot that. Okay? So ang question, ano yung value ng stock na to? How much is this stock? Assuming na kayang i-predict, na? Kasi ang assumptions ito, kaya natin i-predict to, no? Na for the next 2 years, 10% yung magiging growth ng dividends. Okay? Again, guys, for valuing stock, ang ginagamit natin is the dividend growth model. Okay? So this is what we're using in order to value stocks. Kailangan alam natin yung dividends. Ma-estimate dapat yung dividends. And a little review, guys. Kanina, tinignan natin kung if the dividend will not grow, no growth rate, ito yung formula. If the dividend will grow by a constant growth rate, ito yung formula. And it turns out that the constant growth rate, of course, will yield a higher price of the stock. Kasi nag-grow yung dividends natin. Ito walang growth. Tingnan nyo, ang layo ng ano, no? Ang layo ng difference. Okay, so here, going back here, guys. So 10% for the first 2 years, 5% for the next 5 years, 6% for the next 3 years, etc. Okay, then 5% na raw yung susunod na long run growth. Ito. So from this one, continuous na, no? Hindi ko na lang tinuloy-tuloy, but tuloy-tuloy yan, no? Continuous growth rate na yan. Okay. Now, ang question, what is the price of this stock? Okay, so yun ang gusto natin malaman. Ang dividend daw ngayon is 1.6. Okay, so we have to plot the dividends. So what we're doing here, tingnan nyo guys, pre-nat ko yung growth rate, ano, para ma-compute natin yung dividend in this particular years. So this is equal to the previous year multiplied by 1 plus your 1 plus the growth rate. Yan. So the next year 1.76 yung ano yung bonds, no? Yung dividends. And then dito pwede natin tong i-copy hanggang tuloy-tuloy, no? There. So these are now your dividends, no? Okay. So every year nag-grow siya, iba-iba nga lang yung rates. Pero ang question, saan yung constant growth rate, no? Andito yung constant growth rate here. So constant na to. Lagay ko lang. So the constant growth rate starts with this one. Okay, na ang question, paano natin kukunin yung price na to? Kasi ito, di ba? Walang katapusan to, tuloy-tuloy pa to eh. Di ba? Tuloy-tuloy pa yan, no? Hanggang forever yan, no? Hanggang forever. Good thing guys, based on the math, no? Mako-compute natin. Paano? Gagamitin natin to. Yung concept na to, yung constant growth rate. So going back here, saan magsisimula yung constant growth rate? Dito, no? So kung dito magsisimula yung constant growth rate, then we will be able to convert this, papalitan natin tong uniform stream of cash flows, infinite stream of cash flows into one price here. Yan. So pwede natin palitan ito from 3615 hanggang dulo, papalitan natin yan ng isang value. Ito. So ano yung value na yun? Using this formula, guys. Ito. Diba? Sabi natin, mathematics can prove that. Oops, hindi na copy. Control C. Control V. Ito, no? D sub 1 over K sub S minus G. Yung D sub 1, guys, kung saan nagsisimula yung continuous growth rate. No? Yung first, ito. So assuming, guys, pwede natin masabing time 0 to, this will be time 1. Therefore, itong buong to, we can replace that by one single value, which is equal to, that value is equal to D sub 1, in this case, ito yung D sub 1 natin, divided by, ano yung K sub S natin? Our K sub S is given at 10%, okay? 10% minus G, what's your G? 5%, yung constant growth rate natin. Okay, so let me, okay, so what happened here? We replaced ito, lahat ng to hanggang infinite yan, we replace it with one value. Ito na yun. We replace it with 172.3. So what happens now? We are now reduced into, ito na yung mga cash flows natin. Ito. So this one is not included kasi, guys, di ba? Tapos na yan, no? Ang tinitingnan natin, guys, in order to price a stock, yung future dividends, which we have reduced into this one. Yan. Diba? So, how do we now get the price of the stock? Okay, well, kunin natin mga present values nito. Kunin natin present values. Okay, so, this one, kunin natin present values nila, no? Let me insert here. So we can just add this sum. Copy lang natin yung format ito. Okay, and then we can just copy this. Sinam natin, although wala naman tong values, ano? And then we can now get the present value. What's now the present value of this? So this is equal to, lagyan natin ng time, no? We need to put the time here. So this is equal to negative PV. Okay. The rate is, what's the rate? Itong 10% natin, naka-fix siya. N per is this one, 14. Wala tayong PMT. Okay. Ang future value natin is this amount. Okay. Control Enter. Format lang natin. And then I can now copy this there. Okay, so what have we done? We have converted this into present values. Present value na lahat yan. Therefore, we can now add it sum ng mga present values. Okay, so the price of this stock is 36.7. Okay, ang price ng stock is 36.7. Okay? Or we can, alam nyo naman yung NPV formula, yung shortcut, NPV is equal to NPV. Okay, pwede natin magamit to kasi future cash flow to, no? Okay, asan yung mga cash flows natin? Sulat natin dito, dividends. Ito yung mga dividends natin, no? Ito yung mga present values nila. Okay? But we can use the NPV function. NPV ang rate natin is 10%, comma. Values natin are the dividends. This one. And take note, we can do this. Wala na tayong i-add kasi year 1 to eh. This 1.6, 1.7 will be given after 1 year. Yan, so pareho lang. You can see that they're the same. Okay? So this scenario gives us the price of this stock. The price of this stock, 36.7, given this dividends. Okay, so kasama sa exam to, no? Okay, and then here, yung dividend yield lang. Dividend yield is dividend at year 1, okay? Divided by the price now. The price now is, sorry, this one. Okay, but may dollar to. Price is 36.70. Bakit may dollar? Okay, so the dividend yield is just, okay, oops, is equal to this divided by this. So the dividend yield is 4.8%. Okay. All right, so that takes care, guys, of your stocks. Okay. So then we go to the next one, itong weighted average cost of capital. Okay. Remember that when we were computing for capital budgeting, gumagamit tayo lagi ng weighted average cost of capital. So paano ba kino-compute yun? So this is just this is a lesson on how we basic computation of weighted average cost of capital. So we know that the firm's capital structure consists of yung capital structure ng firm. It's how the assets are financed, no? So yung current assets usually financial ng current liabilities. Pero yung long-term assets like fixed assets, dapat ang nagfa-finance yan, long-term debt or equity. So ang tawag natin dito, yung long-term debt at saka equity, that's your capital structure. Tapos yan na ginagamit natin na basis for computing for the weighted average cost of capital. Okay? So the basic concept is that importante na malaman natin makompute yung weighted average cost of capital. Otherwise, we might come up with wrong decisions. No? Wrong decisions about, kunyari ito example. So for example, mag-i-invest yung company ng 100,000. Ang useful life ng asset 20 years, IRR 7%. Tapos, kung titingnan lang natin yung debt na source of financing, okay, baka sabihin natin, ay okay yung project nito kasi IRR 7% greater than the cost of debt. No? Cost of debt lang kasi tiningnan dito eh. So that's wrong kasi dapat ang titingnan na cost is the weighted average cost of capital, not just the cost of debt. So kasi ito, mangyayari, baka magre-reject tayo dito ng project, baka magtatanggap tayo ng project na mali yung ginamit natin ng basis. Okay? It should not be the only the source of financing debt. It should be the weighted average cost of capital. Ganun din to. No? Dito sa project na to. No? Reverse lang. Okay? So, the basic concept is that when we evaluate projects, kailangan ang ginagamit yung weighted average cost of capital. So, how do we compute for the weighted average cost of capital? So, yung weighted average cost of capital, ang formula niyan is WI times K sub I. No? It's the sum. No? It's the sum of all the financing costs multiplied by its weight. Okay? So, pause lang ako sandali guys, kukuha lang akong tubig. Ay, sorry. Naka-mute pala ako, sorry. So, as I was saying, guys, ang weighted average cost of capital natin is computed by weight ng debt times cost ng debt times 1 minus tax rate plus weight ng stock times the cost of stock plus the weight ng preferred times the cost of preferred. Now, minaminus natin yung tax rate, no, dito sa cost of debt kasi if you recall, guys, nagkakaroon tayo ng tax savings, no, by using debt. If you recall that, nagkakaroon tayo ng savings, tax savings by using debt. So the cost actually we have to account for that. Kaya yung cost, bumababa actually yung cost because debt provides us reduction in the computation of tax. Okay, so in this dito makikita natin, guys, yung yung how to compute for the cost of the debt. Tapos dito naman yung for the cost of the preferred stock. Okay, and this one, cost of common equity. Okay. And then here you have the computation for the weighted average. Actually, ito weighted marginal cost of capital. Okay. Although ang titingnan lang natin, guys, yung weighted average cost of capital. Okay, which is this one, no? So the formula here is that the weighted average cost of capital is equal to, okay, the weight of each of the financing na ginamit. So kunyari weight of debt to times cost of debt. Pero kung debt to, dapat may 1 minus tax to, no? Okay, so let's have an example here. Okay, so it calls for individually computing for the cost of each, cost of debt, cost of stock, and cost ng preferred stock. Kasi kung alam natin, guys, yung capital structure, madali na ma-compute yung weight ng debt, weight ng stock, at saka weight ng preferred stock. Okay, so the best way, guys, is to have an example, no? So let's okay, let me illustrate this example. So we need to compute first for the cost of debt. Ito. So we're given that the price, ang sabi, suppose a company could issue a 9% coupon 20-year debt with a face value of 1,000. So alam natin to, no? 9% coupon rate, 1,000, so 980. So ibig sabihin nito, guys, it's selling at a discount, no? Diba? So ibig sabihin yung market rate, we will expect that the cost of debt will be greater than the coupon rate na 9%. Okay. Tapos sinabi dito na may flotation cost, 2% of face value. Ang ibig sabihin ng flotation cost, guys, pag nag-i-issue ng bond yung company, it will necessarily hire the services of, let's say, an investment bank or companies that help them issue the bonds. So may binabayaran sila for them to issue the bond. And in this, sabi, 2% daw yung cost. Ibig sabihin, yung 980 na makukuha niya, okay, babawasan pa natin ng 2% yan kasi they have to pay the services of the investment company that will issue the bonds for them. So ibig sabihin yung 980, ang makukuha lang niya dyan, 98% niyan, no? Hindi kasi yung 2% ibabayad pa niya yan. Okay, so let's write down yung mga ano natin. So the price of the bond is 980, kaso, okay, 980 ba? Okay. Net proceeds 960. Saan nanggaling to 960? Is equal to 980 multiplied by 98% na lang, ano? Okay. So it's equal to 980 here is our net price. Okay. Yung price 980 pero sabi natin may flotation cost siya na 2%. Okay, so sulat nga natin dito for clarity. Flotation cost. Flotation cost is 2%. Okay, so this is how we solve the problem. Ang price daw to be paid to the company is 980. However, my flotation cost, therefore, ito guys, this is equal to 980 times 1 minus 2%. Kasi babawasan ng 2% yung price. So that's 960.4. Okay. How much is the interest? Par value is 1,000. Okay. Interest, lagay natin coupon na lang. Coupon rate is ilan? 9%. Term is 20 years. Par value or face value is 1,000. Okay, so we can compute actually for this one. Okay, how do we compute for the cost of that debt? This time we're going to use the rate function. Kasi ito yung hinahanap natin, ano? Hindi natin hinahanap yung present value. Given sa atin yung present value ito. Okay, so we're solving for the rate, for the cost of debt. N per natin is 20 years, comma. What's our PMT? Our PMT is 9% multiplied by the face value. So 90 yan. And then the present value is, magkano daw yung babayaran ngayon? Okay, present value is 90. Okay, then this should be negative, no? Negative 60.4, and then the future value is 1,000. Okay, take note, magkapareho ng sign yung PMT at saka yung future value. Yung iba, yung negative, yung net price. Okay? Kasi ito yung uutangin ng company, no? Ito yung mauutang niya, 960.4, tapos ang babayaran niya yung 1,000 at saka yung interest na 1,000 times 9%, yung coupon. Okay, so the rate is 9.45. However, guys, pag debt, laging after tax. No? So 80 here means after tax. Sulat ko na lang dito. After tax cost of debt. There. So, pag kinumpute natin yung WACC, ito yung gagamitin natin. No? We're going to make use of this 5.67 dito sa formula dito. Dun sa weight multiplied by the cost. Okay? Weight multiplied by the cost times 1 minus tax rate, which is actually itong 5.67, no? Okay, now for the for the preferred stock. Sa preferred stock madali yung cost, no? Kasi ang preferred stock, ang nature ng preferred stock, parang bonds din yan. So yung dividends niya fixed. So for example, ito, a company could issue preferred stock that pays $5 annual dividend and sells it for 55 pesos and have to pay $3 per share to sell it. So how do we compute for this? Ang formula, guys, ang cost of preferred stock is K sub P is equal to the dividends divided by the price tapos minus the flotation cost kung meron. So here, you can see that the cost of the preferred stock will be equal to magkano yung dividends. So yung dividends yan, constant yan. No? Kaya $5 divided by magkano daw yung price? 55. Tapos may flotation cost na 3, so babawasan natin yung 3 na flotation cost. Okay, therefore, we were able to compute for the cost of preferred stock na 9.62. Okay. And lastly, itong cost of common stock naman. So this is your cost of common stock. So the formula that we're going to use is, okay, pwede natin gamitin to, yung constant dividend growth model. So the formula is simply, okay, K sub S is equal to D1 divided by the price plus the growth rate. Okay, so it's D1, the dividend at year 1, divided by the price now plus the growth rate. Okay, so this is an example. Nagbigay daw yung company ng dividend, no? Just pay the dividend of 2.5. Then it will grow by 10% indefinitely. The price now is $50. So how much is the cost of the stock? So using this formula, K sub S is equal to D1 over P sub O. D1 is 2. Saan nagaling yung 2.75? Kunin muna natin D1. No? D1 is 2.5 times the growth rate of 10%, so you get 2.75. So and then plug that there, 2.75 divided by 50. No? Kung may flotation cost pa to, ibabawas natin yung flotation cost and then plus the growth rate. So you now have 15.5%. Okay, so once we get the cost of debt, cost of equity, cost of common stock, and cost of preferred stock, mako-compute na natin, guys, yung weighted average cost of capital natin. Okay, so how is that done here? Okay, so let's assume that the dun sa balance sheet, no? Continue natin to. Si debt daw 40 million yung value niya sa balance sheet. Si preferred stock 10 million, tapos si equity 50 million. Ang ginamit dito market value, no? So if we have data about the market value, pwede natin gamitin yon. Pag wala, ang ginagawa minsan yung book value na lang. So si debt daw 40 million sa balance sheet, market value niya preferred 10 million, si common 50 million. So all in all 100 million to. Now we can easily get the weight of debt, which is 40 million divided by 100 million. So that's 40%. Si preferred 10%, and then si common equity 50%. So we just compute for that. The weighted average cost of capital is 40% of the after-tax cost of debt plus 10%, which is your preferred stock, times the cost of preferred stock, plus 50% times the common stock. Okay, 15.8% na nakuha natin dito sa 15 point, ano ba ginamit dito? 15 point, ito yata yung ginamit, no? 15.8 or whatever here. Medyo magkakaiba sila. Depende dun sa method, dun sa pag-compute sa ano. Okay, and then, if we compute that, then we're now able to compute for the weighted average cost of capital. Ito na yung ginagamit, guys, para dun sa magdidetermine ng kung ang investment is feasible or not. Okay, so let's take a look at examples here. All right. So, given tayo ng ano, no? Given tayo ng debt, preferred, at saka common. Okay, then we are asked to compute for the weighted average cost of capital. Meron tayong additional data dito. Okay? additional data for bonds, for preferred, at saka sa common. So kailangan natin ma-compute ito yung mga K sub I natin. No? We need to compute for the costs. Cost of debt, cost of equity. Kasi alam na naman natin yung mga weights eh. No? So here we're given that yung debt ngayon, ang price siya 904.53, tapos ang number of units siya 400. So to get the market value, we just multiply this. Okay? So makukuha natin guys yung weight ng debt, weight ng preferred, weight ng equity. So this is your W sub I. Ang kulang na lang natin yung K sub I. So what we lack is your K sub I. Okay? So kailangan natin makuha yung after tax cost of debt. So this, paano natin na-compute to? Okay, alam natin yung price ng debt, no? 904. Tapos may flotation cost. Tapos alam natin yung PMT. Ang PMT natin is 10% times 5,000. Ang maturity natin is 10 years. Okay, may tax rate tayo na let's change this. Let's make this, gawin na natin 32%. No? 32%. Okay, so we can now compute for the after-tax cost. Diba? Paano natin kinukompute yan? Rate yung ginagamit natin. No? Rate. Enter natin, number of periods ng utang is 10 years. Comma. PMT natin, yung annuity is 10% at ng face value na 1,000. No? Okay. Yung price, magkano daw? Yung price is 904.53. Kaso may flotation cost. No? Ibig sabihin, magbabawas tayo ng 1%. So 1 minus 1%. So that's the price. Okay? And then, comma, what is the future value? The future value is your face value. Yan. Okay? Kaso nga lang, take note guys, dapat yung isa negative dito. No? So gawin natin yung price negative, tapos yung annuity, yung PMT at saka future value positive. Or you can reverse guys, pwede nyo ilagay negative dito sa PMT at saka yung sa future value. Dapat pareho sila negative. Tapos positive yung present value natin. Okay? And then what do we have to do with this one? Kailangan guys, times 1 minus tax rate. No? Kasi dapat after tax, 1 minus tax rate. So that's tax rate is 32%. Okay? So this is the after tax cost of debt. After getting the cost of debt, minus natin yung yung tax. No? So that's your cost of debt, 805. For your preferred guys, madali siya. Okay, may dividend tayo. Dividend. So dividend, this is, kasi ang dividend ng preferred, constant yan eh. No? So sabi natin, it's equal to D1, okay, divided by the cost, no? If you take a look at this, guys. So for preferred, it is the price, no? The dividend divided by the price net of the flotation cost. Okay, so balikan natin to. So this is equal to, what's the price of the preferred now? What's the price? The price is at, magkano yung price ng preferred? It's at 100, di ba? So 100, ulitin ko. It's equal to dividend divided by the price at 100, okay, times, babawasan natin yung 2% na flotation cost. Okay, the flotation cost kasi is shown in percent. So this is the percent of your price. So binawasan natin yung price ng, okay, so that's 10.2%. Ang cost ng preferred is 10.2%. And then lastly, okay, you have your cost of equity. So ano yung formula ng cost of equity? Okay, so your cost of equity, sabi natin, is this one. Dividend at year 1 divided by the price plus the growth rate. Okay? So let's copy this. Okay? So that's dividend at year 1. What's the dividend at year 1? Ang dividend at time 0 is this one, 3.96. No? So we have to multiply that by the growth rate. D02 eh. So ang D1 will be an increase of 6% over the 3.96. Okay? And then you divide this by the price. Okay, the price is now, how much is the price? 70, but you have to reduce that by times 1 minus, kasi may flotation cost. Okay, so binawasan natin yung price ng 5%. Okay. So clinose ko siya. So this is the numerator. D1 is the dividend at time 0 times 1 plus 6% growth rate. Yun ang D1. And divided by the price, this is 70. However, babawasan natin ang flotation cost. So times 1 minus the 5%. In other words, dapat 95% na lang nitong 70. And then, plus, you have to add the growth rate, 6%. Okay. So that's it, guys. 12.31% yung cost of stock. Usually, guys, yung cost of stock yung pinakamahal. Cost of common stock compared to cost of preferred at saka cost of debt ang pinakamura. Therefore, the WACC, guys, is equal to sum product. Sum product. Ito yung mga weights natin, comma, ito yung mga cost ng debt natin. Okay. So that will be 10.8%. Ito na ngayon yung gagamitin, guys, in evaluating yung capital budget projects. Notice, hindi ito lang ginagamit natin. Hindi lang yung 10.2, hindi yung 12.31, but a weighted average, weighted components of all of these three. Okay? So lastly, ito practice lang. So for this last exercise, okay, so we compute for the cost of debt, cost of preferred, and cost of equity. Okay, cost of debt muna, after tax is equal to, ba, as usual yung rate natin, rate. Ano ba yung NPER natin? Okay, may frequency dito, ibig sabihin semi-annual to, 2 times a year. So our NPER will be 10 years, okay, times 2. No? So 20 periods tayo kasi semi-annual eh. Kama PMT, what's our PMT? Our face value multiplied by our coupon rate, okay? Then we have to divide this by 2. Right? So yung interest natin is 9% times 1,000, but divide by 2 kasi twice a year magbibigay ng interest. Our present value is, ano yung present value natin? Diba, ina-negative din natin to kasi negative yung present value tapos ang ginagawa natin yung annuity natin at saka future value positive. Our present value is 945. Ito yung price ngayon. Kaso, may flotation cost, no? Times 1 minus, binawas natin yung flotation cost na 2%. Okay? And then, comma, future value natin is our 1 million. 1 million. And then, dapat times 1 minus tax rate. Our tax rate is 35. Okay, so that's our cost of debt. 3.31. Eh, kaso, guys, yung rate pala nito is this rate is, this rate is semi-annual. So we will have to multiply it back by the frequency. Okay, yung rate na nakuha natin dito is semi-annual. But ang kailangan natin yung annual rate, so that's 6.63. Okay, how about for preferred? Very easy. It's the dividend divided by, okay, the price. The price is this one, and then minus the flotation rate. Okay, nagkataon dito na zero yung flotation rate, pero pag iba yan, lagyan na lang din natin. So that's 8.8%. Kasi kung meron to, kunyari 1%. Diba? Nabago yung price. Anyway, lagyan na natin na 1%. And lastly, guys, okay, a cost of new equity and cost of retained earnings. Anong difference sila? Parehong formula. Okay, copy natin to. Same formula for cost of equity. Ang kaibahan lang, guys, yung price dito, walang flotation cost. Ito may flotation cost, di ba? Pero pag cost of retained earnings, wala siyang flotation cost kasi the money is already with the company. Okay, so let's compute for this. It's equal to our dividend at D1. Ito na yun, D1 na yun, no? So D1 na siya, dividend at year 1. Okay, then divided by the price. The price is this one. Okay, so wala tayong flotation cost na i-adjust. And then plus the growth rate. The growth rate is 7% there. So the cost of retained earnings is 10.01. Okay, but if it's a new equity, so anong kaibahan niya? Yung sa price, may flotation cost. So D1 is this one, then divided by, what's the price? 41.5, but we have to net this. Babawasan natin yung 8% na flotation cost. Okay, and then plus G. So mas mataas, guys, si new equity. Okay, with that, guys, ito na yung cost of debt natin, cost of preferred stock. So depende sa common equity kung yung retained earnings ba yung gagamitin o yung new issues of shares. Okay, so let's use market value and book value. Meron tayong book value dito. Market value wala pa. So magkano yung market value natin? Yung common equity natin, 240 shares multiplied by magkano yung price na ngayon? 41.5. So that's the market value. Si preferred naman, 2,500 coupons multiplied by magkano yung price ni preferred ngayon? 125. Take note, hindi natin pinabawas yung flotation cost, no? Kasi ang pinag-uusapan natin dito, magkano siya in the market. So that is 3,100 coupon. Preferred pala, guys, ano to, stocks din to, no? Si debt naman, 3 times, 3 times, magkano yung price niya ngayon? The price is at 945. So that's at a discount. Okay. Therefore, we can compute now for the weights. This is equal to this divided by the total. The total of your market value. Fix natin to. Yan. So if you're using market value weights, guys, ito gagamitin natin. Yung book value naman, given na sa atin to, this one divided by the sum of your book value, F4. So magkaiba sila, no? Okay, so we'll just compute for the market values. Okay, market values lang ko compute natin. Bahala na kayo dito sa book value. Anyway, pareho lang naman. Okay, so what will be the WACC, guys? The WACC is equal to, if we're using retained earnings, is equal to weight ng debt, no? Market value ng weight ng debt multiplied by the after-tax cost of debt. This one. And then plus weight ng preferred multiplied by the cost of the preferred. This one. And then plus weight ng, mali pala, sorry. weight ng common stock multiplied by the cost ng common stock using the retained earnings. Okay. So ito, I'll have to change this. Weight ng debt, this is the weight of the debt. Okay. So ulit, weight of the debt times after-tax cost of the debt, weight ng preferred times cost ng preferred, weight ng common times the retained earnings cost ng common. Okay, ang only difference is that, let's copy this. Control C. Copy natin. Ang mababago lang itong B. Magiging B27 to. Okay. So this is our answer, guys. No? Kung ginagamit natin hindi new issues of stock, then 9.23%. If it's new issues of shares, 10.19. Okay, so that now takes care of our weighted average cost of capital. Okay, last, this will be our last topic, yung risk and return. Okay, this will not take long. Yung concept ng risk and return is that, alam natin na we discussed that the higher the assumed risk, the higher is the required return. So in this in this new file that I sent you, andito yung price natin. So sinama ko to si Standard and Poor's. No? Ang ticker symbol niya is GSPC. Standard and Poor's, S&P 500, is a basket of 500 stocks. And it's oftentimes used as a proxy for the market. So, saan siya ginagamit? Kunyari, you would want to compare a particular stock and how it relates to the market, how does it compare with the market, then we can use the GSPC or the Standard and Poor's. Kasi as I said, the Standard and Poor's consists of 500 shares of stocks. No? Now, this was all downloaded from Yahoo Finance from January 2015 hanggang December 2030. So sinama ko na dito yung GSPC. Okay, this is just a subset, all 2020 lang. Okay, so we're not going to use that. Okay, nasama nga lang itong si... Okay, nasama yung GSPC. So, pakitanggal na lang guys, no? Okay. So what we're going to do is, ito yung gagamitin natin. Okay. First, we need to learn how to compute for returns. So let's just take an example of one. Si Facebook lang ng 2020. How do you compute for the returns? Okay, given, kunyari, prices ng stocks, no? Ginawa natin sa Yahoo to, for 2020, for the whole year. How do you compute for the returns of Facebook for 2020? There are two ways to compute this. We can use the simple returns, or we can use the log returns or the LN, natural log. Ang usually na ginagamit itong natural log. Pero how do you compute for the simple returns? It's simply the price now divided by the price yesterday minus 1. So ganun lang siya. No? Price now divided by yung price yesterday minus 1. So it's just like the growth rate between now and yesterday. Ito naman guys, yung log returns, you use the LN function in Excel. LN of this one divided by that one. Walang minus 1. No? Okay? So hindi naman siya nagkakalayo. No? Okay, then we can just copy this down. Yan. So that's now our returns, daily returns for 2020. No? So we just get the average returns. So that's the average of this, Control Shift up arrow, Control backspace. Average lang from C3 to C253. C3 yung unang line ng returns natin. And then we can copy this to the right. Okay. Gawin natin percent. So 0.14 kung simple returns yung ginamit natin. 0.1033 kung ginamit natin log returns. Usually ang ginagamit yung log returns. And then to measure risk, no? Ang risk is measured by standard deviation. Sample.s kasi sample lang naman to. So we once again highlight the returns. Okay. All right. So let's use this. So ang average return ni Facebook for 2020 daily returns is 0.1033%, no? Tapos ang standard deviation niya 2.911. Daily to guys, daily. Ba't sabihin niyo bakit parang ang liit, no? Kasi daily lang. If you want to compute for the annual, ang ginagawa natin dyan is we multiply that by 252. 252, so that's around 26% annual returns. No? 252 kasi there are 252 trading days in a year. No? So yun ang ginagamit na na daily returns. No? Okay. Right. Tapos pag standard deviation, it's the square root of times square root of 252. So that's 46%. Okay, let me check this guys, kasi square root of 2, but I think this is correct, no? Okay. So let's go here, guys, kasi ang pinag-aaralan natin yung portfolio risk and return. So ang gagamitin natin dito is 10 stocks, Facebook, Apple, Amazon hanggang Alibaba, Adobe, Cisco, Tesla, Microsoft, Intel, Netflix. So these are stock prices taken from Yahoo Finance. Okay, ang objective natin ito. Ito nasa ilalim, no? So that's our objective. Paano natin mako-compute yung returns, individual stocks at saka yung portfolio. So let's start first with, okay, let's compute for the log returns nila. So is equal to ln. How do you compute for the returns? Ln of day 1 divided by day 0, no? Yung ginawa natin kanina. Okay. So copy this to the right. Hindi ko yata natanggal yung kay Alibaba, no? And then copy down. Okay. So there. So ito na yung mga log returns natin. So we can now get the average, no? Average is equal to average. Okay. By the way, guys, yung binigay ko sa inyong file, if you notice, kunyari si GSPC, oops. What we can do is, bigyan natin ng pangalan tong series na to, no? Okay, so we can highlight this hanggang baba, no? Although ginawa ko na kanina to, but I'm going to show you. So this one, no? This one, kasama yung title sa taas. Okay, Control Shift F3. Alala nyo to? And then let's give the name at the top row. Okay, so what we're doing is that yung array na to, yung mga returns ni GSPC, Facebook, may pangalan yan, no? Okay? So let me illustrate that. So hinighlight ko yung mga returns na to. Tingnan nyo guys, may pangalan siya, GSPC. No? Since we already gave it a name. So yung series na yan ng returns, if you click this, dari si Adobe, ayun, ayun si Adobe. No? Yung returns ni Adobe lahat hanggang dulo. Okay? So we can actually use that. So is equal to average, no? Average nino. Actually average ng returns, ano? Kaso mahaba pa siya. So what we can do is average, pwede ba nito? Average ni GSPC. Okay? Hindi siya pa pwede kasi hindi naman na-recognize to eh. Alam natin na si GSPC, guys, it corresponds, it represents yung mga stock returns na yan, no? So we want to make use of this name. So what we can do is average ni, we can use para maintindihan ni Excel si GSPC, we can use this indirect, no? Indirect. So ang gagawin ni Excel niyan, titingnan niya yung GSPC tapos yun ang ano niya kung ano yung ibig sabihin ng GSPC na yan, and we gave it a name, yung array ng mga stock returns na yan, di ba? Yun, so nakuha niya. So we can copy that to the right. Di mas convenient, ano, kasi hindi na natin i-highlight yung mga ano. So ang risk naman, stdev.s sample, and then again indirect. Gamitin natin si indirect para hindi na natin ha-highlight yung buong returns. Okay, that one. And then, okay, tingnan muna natin to, no? Which of the stocks, except for the index, which of the stocks has the highest returns? So here it turns out that ang maximum dito is Tesla, no? So nung 2020, kailan ba to? This is from 2018 ang ginamit natin, ano? From 2018, in the whole of 2018, si Tesla yung best performer, 0.316. Okay, tapos sunod si I think si 155, si Apple ang susunod, no? But the highest performer was Tesla. However, ang pinaka-risky by virtue of the standard deviation, sino yung pinaka-volatile yung price ng stock, the returns? Si Tesla din. And that was expected kasi sabi nga natin kapag mataas yung risk na ina-assume, mataas din yung required return. So Tesla was also the highest in terms of riskiness. So how do we decide, guys, kung individually sinong pinakamaganda na stock dito? Except for the index, no? Sino mas maganda? In terms of return, si Tesla. In terms of risk, ang pinakapangit si Tesla. Ang pinakamaganda actually itong si Cisco, no? Kasi siya yung pinakamaliit na risk. So if you're looking for the minimum risk, si Cisco pinakamaganda. If you're going to look for the highest return, si Tesla. So there's a way to determine, so sino mas maganda, by standardizing it with the coefficient of variation. So paano si coefficient of variation is equal to the risk divided by the unit return. So let's get that. Okay. So itong measure na to, guys, is risk per unit return. So magkano daw yung sa isang unit na return, isang percentage na return, ilan yung risk na ina-assume mo? And it turns out, guys, na the best is si Tesla, no? Kasi siya yung pinakamaliit na risk na i-assume for each one unit of return. Si Cisco mataas, oh. Mataas. Kasi kahit na mababa yung standard deviation niya, ang baba din naman ng ng returns, no? 3.03% lang. Okay, so if we're going to rank this, Tesla is best in terms of coefficient of variation, which is how much risk is being assumed for every 1% unit of return, 1% return. So si Tesla pinakamaganda, tapos pangalawa si si Apple. Okay, ang worst sa kanila, yung pinakamataas is si Cisco. Si Cisco nga. Si Intel pala. Worst. Kasi for every 1% return, you're assuming 167 units of risk. No? Okay. Now, usually guys, hindi natin tinitingnan to individually. No? Tinitingnan natin to first, individually, kung titingnan natin, ang question, how risky is your asset relative to the market? Pag sinabi natin market, kino-compare natin yung asset natin to a particular market. In this case, GSPC yung gagamitin natin. So for example, which of these are the riskiest compared to the market? So ang ginagawa natin dyan guys is ipa-plot natin yung returns ni GSPC versus FB. No? So let's do that. Highlight natin si GSPC and FB. Insert tayo ng scatter plot. Okay. So that's what we see guys. No? Ito yan. Actually, ito yan. No? Actually, it's this one. Pero let me just illustrate. So we plotted ito kasi, itong nasa x-axis natin, si GSPC. Okay? Tapos yung Y natin, si Facebook. Okay. How do we measure risk of Facebook relative to the market? The riskiness of an asset relative to the market is measured by what we call beta. Okay, so beta is the relative movement of your asset compared to the market. And we can do that by this one. Okay. So click any point here, add trend line. Okay, add trend line and then linear and then set equation on chart. Okay. So here we have this, nakita nyo itong trend line na to, no? Tapos makita nyo itong let's increase that size. Okay, you have an equation here. Okay, ang beta dito guys, ito, yung slope, no? Y, which is Facebook, is equal to 1.0721 times X, which is your GSPC. The slope is 1.07. Anong ibig sabihin nun? Ang ibig sabihin ng 1.772 guys, is that when the market, which is GSPC, increases by 1%, Facebook will increase by 1.072. So it's riskier than the market, no? Kasi mas mataas yung laki niya kung yung market nag-i-increase ng 1%. 1% increase in GSPC, 1.072 increase in Facebook. That situation is good, guys, kung bullish yung market. Ibig sabihin pataas yung market. A 10% increase in GSPC will mean a 10.72% increase in Facebook. However, pag reverse siya, okay, delikado naman si Facebook kasi mas mataas yung decrease niya. Pag bumaba si GSPC ng 1%, si Facebook bababa ng 1.72%. Okay. So, you can do that for the others, no? Pero pwede natin i-compute yan kasi slope lang siya. Okay? Since slope lang siya, then we can easily compute that, no? Okay, so beta is equal to slope. Ano yung known-wise natin? Yung known-wise natin, ano? It's equal to, ang Y natin should be si Facebook, si Apple, no? So what we can do is indirect natin to, no? Indirect of this one, okay, that's our Y, comma. What's our slope? Our slope is indirect natin to. Indirect natin si GSPC. Kaso i-fix natin si GSPC para hindi siya aalis doon, no? So we're computing for the slope of Facebook and then GSPC, and then i-drag natin to the right, Apple and GSPC pa rin, etc. Control Enter. So yun nga, nakita natin guys yung 1072 kanina. Copy to the right. Wait, sorry. So this one should be Okay, mali ito. No? Indirect dapat ni... Okay. So ito, indirect of GSPC with GSPC. No? So we'll compare first the beta of GSPC with itself, tapos kanan na natin. So I expect 1, guys. Yan. Okay. So this is now correct. Okay, tignan nyo guys. What is the slope? What is beta? Remember, ang beta guys is a measure of the riskiness of your asset compared to the market. Ang market natin dito in GSPC. So syempre, yung riskiness ni GSPC with itself is 1. Perfect yan eh. Ito yung 1072 natin kanina, ito yung 1187. So the higher the higher the beta, the higher is the riskiness of the data. Okay? So ang pinaka-risky natin dito is ito si Adobe, no? Si Intel pala, 1.214. Ibig sabihin yan, for every 1% increase in your market, GSPC, Intel will increase by 1.21. Again, that's good. However, ang reverse yan, guys, we know that the reverse can be fatal also. Yung least risky is 0.905. Kasi ibig sabihin yan, pag nag-increase daw si GSPC ng 1%, si Amazon ang i-increase lang niya 0.905. So the lower your beta, the least risky is your asset. So kapag 0 yung beta natin, guys, ibig sabihin nun, ano ibig sabihin pag 0 yung beta? Wala siyang pakialam sa market. Tumaas yung market, hindi siya gagalaw. Bumaba yung market, hindi siya affected by the market. That's what we mean by beta equal to 0. So the lower the beta, the least risky it is relative to the market. The higher the beta, the higher is the riskiness of the asset relative to the market. Okay, so we have this last 3 questions. Okay, this will not take long, sorry. So una guys, ang objective guys ng investment is for you to come up with a portfolio. Kasi pag nagpo-portfolio tayo, anong nangyayari? Yung riskiness natin as measured by the standard deviation, the riskiness is reduced. Kung iisa lang guys yung asset natin, ito si Facebook, 2.41% yung risk natin, no? As measured by standard deviation. Mas liliit kung yung riskiness natin kung if we create a portfolio. Okay, so dito gagawa tayo ng portfolio ng 10 assets natin. Okay, ito yung mga assets natin, di ba? Kopya lang natin dito. Yan. Yan yung mga assets natin. So una, ang gagawin natin, since 1, 2, 3, 4, 5, 6, 10 siya, bibigyan natin siya ng tiga 10% sila. No? So 1/10 lang. Tapos dito may sum tayo na 1%. No? Okay, so these are the weights. Ibig sabihin, tigta 10% yung investment natin sa mga stocks na to. With that, kung alam natin yung weights guys, at saka kung alam natin yung returns ng assets natin, ito, we can compute for the portfolio return. Yung portfolio return is simply the weight of the asset times the return. No? So, individually, i-multiply natin yan, then i-add up natin. Kasi yun ang 100% natin. And the shortcut there is the sum product. No? So, dito sinum product natin, yung returns at saka yung weights. Ang gagawin ni Excel dyan, i-multiply niya bawat isa, tapos i-add back niya. Okay? So what happened here was, yung return natin, 0.113%. Okay, so yung portfolio natin, 0.113, notice that it's lower than your Tesla, no? But it's higher than Facebook, higher than Alibaba, higher than Intel. So anong nangyari guys, yung returns natin na to, it's higher than some of the assets, but it's lower than some. Okay? Mas mababa siya kay Tesla. Ganun talaga kapag portfolio, meron kang may returns sa portfolio, yung total returns natin, may mas mataas sa ibang assets, may mas mababa naman sa ibang assets. Okay, pero hindi yan yung pinakaano ng portfolio. Ang pinakaano ng portfolio guys is the risk. Kasi pag nag-portfolio tayo, mababawasan yung risk. So yung risk guys, ito, hindi ko na i-explain na, pero medyo ano yung formula. Okay, medyo kailangan lang natin guys yung kunin yung ang formula ng risk is just, let me just write that. Huh? Okay, quickly review. Ang formula ng risk, so that's ang formula ng portfolio risk. So this is the portfolio standard deviation, di ba, ng portfolio is equal to medyo matrix tayo, no? Weight matrix multiplied by the variance covariance matrix multiplied by the weight transpose. Okay, so medyo ano yung formula, no? Pero let me just illustrate. So meron tayong weight matrix. We already have the weight matrix, which is this one. Ito na yung weights natin, no? Okay, meron na rin tayong weight transpose. Weight transpose, yung binaliktad lang yung weight, no? Ito na lang kunin natin yung variance covariance. So let me show you how to compute for this. So how do we compute for the variance covariance? So madali lang yan sa Excel. We go to data, okay, data analysis, and then covariance. Yan, okay. And then sabi natin, ano daw yung input range? So yung input range natin, ito, no? From Facebook hanggang Alibaba, hanggang dulo. No? Yan, hanggang dito. There. Group by, ang grouping by natin, columns, and then labels in the first row. And then yung output range natin, ilagay natin dito sa Z2. So dito ko pinapalagay, no? Z2, okay. Okay. All right. So this is now our variance covariance. Itong variance covariance natin, itong ano guys, itong diagonals natin, this is just ang covariance ni Facebook with Facebook is just the variance of Facebook. Ang covariance ni Apple with Apple is its variance. So we have the diagonals that are the variance of your stocks. And then ito namang ano natin, ito ano natin, ito nasa andi dito. This is now the covariance. So covariance of Netflix with Facebook is 0.0033. Dapat yan guys dito din yan, no? Kasi covariance ni Netflix with Facebook is just the same as the covariance of Facebook with Netflix. Kaso nga lang hindi sa atin binigay yung buo, but we can copy that quickly, no? So ang gawin natin guys, highlight natin to. Highlight, Control C. Ilagay natin dito. No? Okay? So ang gagawin natin, kokopyahin natin to dito. Okay, so let me illustrate that. So tanggalin ko yung line nito, no? Tinanggal ko lang yung border. Okay, I'm going to copy this. Control C. Okay. Ipe-paste ko dito. Okay, tingnan nyo. Paste special natin. Paste special. Ano ipe-paste natin? Ang ipe-paste natin yung mga ita-transpose natin siya. Okay, tapos skip natin yung blanks. Transpose and then skip blanks. So if I click OK, there. Ang bilis, di ba? Nakopy na natin. So transpose siya. Ibig sabihin itong 0.0032, pareho din yan. So kung titignan mo guys yung mga pairs niya, they're all the same. Okay, so we can now compute for the risk, no? We can now compute for the risk. Ito yung gagamitin natin. Ito yung variance covariance natin. Okay? So this is the variance covariance matrix. So linagay ko na yung formula dito, no? Linagay ko na yung formula. So it's M mult. What's this? This is your weight matrix, ito. Tapos this is your variance covariance matrix yung nasa taas. No? Ito yun, no? Ay, wait. Dali ha. Sorry, palitan ko lang. Mukhang mali yata yung formula ko. This one should be, dapat ito siya. Yan. Tapos dapat naka-fix. Actually, hindi naman kasi, hindi naman natin ikakap. Fix lang natin. And then transpose, yung weight matrix natin, it-transpose, no? Ibabaliktad. And then, take note guys, this is may square root dito, no? Tapos ginamit natin yung matrix multiplication. Okay. Control-Shift-Enter kasi array ito. Control-Shift-Enter. Okay, so 1.877. So that is now the risk of your portfolio. Okay. If you will now compare that with the risk of your assets, except for for GSPC kasi hindi naman kasama si GSPC. No? Ito yung mga assets natin, ito yung portfolio natin. If you take a look at this guys, si 1.877, okay, walang asset na mas mababa pa kaysa risk ng portfolio natin. So that's just telling us that pag nag-portfolio tayo, bumababa yung risk natin. Okay? So ito yung last natin. Ito kasi equally weighted, no? Equally weighted. So ito yung returns natin, 0.113. Paano kung kunyari kung sabihin natin, ayaw ko ng equally weighted. Okay? So ang gagawin natin guys, papahanapin na lang natin si R. So, dali guys. Let me delete this. Delete ko na lang to ha. Let's go straight here. Okay. So, ang tanong natin, ayoko na tigta 10%. Ang gagawin na lang natin, ang minimum na weight is 5%, ang maximum na weight is 30%. So bahala na si Excel maglagay kung sino yung bibigyan niya ng 5% at saka sino yung bibigyan niya ng 30%. No? Gawin natin ang maximum, huwag natin papalampasin ng 20%. No? So how do we do this? Papasolve natin kay Excel kung ilan yung mga weights na ibibigay niya. Okay? Dapat ang total weights pa rin, dapat 100%. Tapos the returns is computed by the sum product of your returns and the weights. Hindi pangalan natin alam kung anong weights. Tapos yung natin, yung risk is, palitan natin ulit to. Yung risk dapat ito. What happened? Oh, sorry. Huh? A3 to A12. A3 to A12. Okay, so as a last exercise, guys, okay, we would like that the portfolio, si Excel ang hahanap ng weights, no? Tapos gusto natin maximize yung returns. Ano yung pinaka portfolio na mama-maximize yung returns? Pero dapat yung weights natin, dapat ang minimum 5%, tapos ang maximum 20%. Bakit natin ginagawa yan? Kasi baka i-load lang niya sa isang asset. Okay, actually yun ang mangyayari kung wala tayong constraint, no? Ang gagawin niya, ilo-load niya lahat kay Tesla kasi si Tesla yung pinaka mataas na returns. Kung gusto natin talagang maximize returns, then lahat ibigay mo kay Tesla, 100% yung portfolio natin kay Tesla. But that defeats the very purpose of portfolio, no? ang mangyayari niyan, ang risk natin 4.29% kasi kung kay Tesla lang. Okay? So what we're going to do now is iso-solve natin to. Okay? So yung returns natin okay na, no? Sum product ng weight at saka ng risk. Yung portfolio risk natin is equal to the weight multiplied by the variance covariance and multiplied by the transpose of the weights. Okay, Control Shift Enter. Okay, so ito na guys, last. So how do we compute for this? We use data and then solver. Okay, si Excel may solver. And then here, ano yung objective natin? Our objective is ito. No? Yung returns natin dapat naka-maximum. Changing cells natin, ano yung papalitan? Parang goal seek lang to din, kaso mas powerful. Ito yung weights yung papalitan. Okay? And then ano yung constraints natin? Okay, let me reset all. Let me delete all of this. Delete. Okay. So ano yung mga constraints natin? Add tayo. Dapat yung total weight natin should be equal to 1. Dapat 100%, no? Okay, kasi ina-add niya yung mga weights, dapat 100% to. Pangalawa, add. Dapat yung mga weights natin, so hinighlight ko yung mga weights, should be less than 0.2. Kasi sabi natin, dapat hindi yung isang asset hindi dapat magkakaroon ng more than 20%. Tapos add, dapat yung mga weights natin, weights should be greater than or equal to 5%. Okay. So, sandali Okay, Control Shift print screen. Okay. So solve na natin to. Solve. Okay, solver found a solution. Okay. Control V. Okay, mali. Anyway. Ulit. Data solver. Para ma-print ko lang yung itong Control Alt print screen pala. Control V. Okay, para kita nyo lang kung ano yung solver parameters natin. That one. Okay. Then you notice guys na ito na yung portfolio natin. Okay, ang sabi ni Excel based on our parameter, 5% ang kay Facebook, kay Apple 20%, 10% kay Amazon 5%. Ito na yung portfolio natin. Okay? So yung iba tigto 20%, yung iba may 10%, tapos may iba na 5% lang. And then based on this guys, based on these parameters, ito yung returns ng asset natin. In fact, mas mataas siya kaysa dito sa returns na to, no? Yung equally weighted lang. Pero mas mataas yung risk niya, no? 2.06. Okay? So given this weight, 2.06, but it's a lot lower than most of the assets here. Si Microsoft lang medyo mas mababa sa kanya sa portfolio na to, no? But for the rest, pati si Cisco pala. Okay? So that's how we compute for the returns ng individual asset, risk ng individual asset, returns ng portfolio, at saka risk ng portfolio. Okay? So ito guys, this will be at least yung pag-compute ng returns, no? I don't think I'll give a question on computing for the risk kasi hindi pa naman natin talaga na-discuss tong function na to. Okay? So, thank you so much and I hope you learned something today. So that ends our term. So, ang ginawa natin, tinapos natin capital budgeting, kinuha natin yung valuation ng stocks at saka bonds, at saka tininan din natin yung pag-compute ng weighted average cost of capital, at saka ito yung concept ng risk and return. Okay. Stop recording ako.